Welcome back to another episode of Vault Talks. I'm your host, JT Miller, and I got a pretty interesting guest for you guys today. So his name is Mike Schwallie down in Birmingham, Alabama. He's actually a fellow West Sider, so he went to Elder High School, went down to Alabama, played college basketball at Birmingham Southern, and ended up just never coming home. So Mike's got an interesting journey. He started out as a business owner. So him and a partner, they owned a moving and distribution company. He ultimately made a shift a few years in and started teaching the infinite banking concept. That's what he's been doing for the last 15 years, and he's been a huge mentor of mine as I grow my practice. He's really taught me most, if not everything, of what I know. So I'm fired up for him to tell his story. I think you guys will love it. Without further ado, here's Mike Schwallie.
Hey, thanks, JT. I appreciate it, man. Yeah, it's been a long journey. I think starting all the way back from the beginning, just to kind of give everybody a little glimpse of my story and how I got here. I, like JT, educate a lot of clients on a number of financial solutions. Primarily, the infinite banking solution is one of the top things that we educate our clients and help them, coach them, and show them how to implement that in their lives. But just kind of going back where I got started, I was a business owner, me and a business partner, did the traditional thing in business planning. We had we had a need for capital. We needed to have a place to park capital. We had a need to access capital, and then we had some insurance needs. And that's really what my advisor kind of showed me is like, hey, you've got this partnership with your business partner that you need an insurance, what we call in the industry a buy-sell agreement or a cross-purchase agreement, just in case, heaven forbid, an untimely death happened to one of the two of us, it would solve for that. So 95% of all business owners that we talk to, they typically just use good old-fashioned term insurance to do that. So we had that in place. At the same time, we had a pool of capital, a savings, high yield savings, a high savings account at the bank, the commercial bank down the road. That was kind of our emergency fund for the business. That fluctuated from 150 to 250,000, during our 10, 15 year run that we had. And it always kind of remained in that pile. Sometimes during the summer months, it was high. During the winter months, it tended to get a little lower. And then we also simultaneously had about a $750,000 to $1 million line of credit at the bank, and moving trucks that seemed like they always broke down, all those kind of things that came along that needed capital to run the business. And when the big purchases came, a lot of times we didn't use our cash. We used that line of credit. Well, when I finally read the book, Becoming Your Own Banker, and I listened to my advisor, what I realized was those three components can be all compacted into one solution. And that's what we use for becoming infinite banking. And so we solved for the insurance component. We had the cash component that continued to compound and grow even when we touched the money, and we'll get into that. But then the third thing was, we had our own personalized line of credit. We had the pool of capital that we had in there that was expanding every day, every month, every week, every year, was our access to capital. We could use it freely whenever we wanted it, paid it off. And because we were a very seasonal business, we made a lot of our money during 9 months, and we kind of held on for dear life during the slow 3 months of the year. We could control the cash flows, and cash flow's king in small business. And so it really, it fit for us extremely well. So just to give you a real life scenario of that, one of the things we bought every quarter was cardboard boxes of all shapes and sizes that we used for packing, for our clients. Well, when we bought in bulk, the price was cheaper, right? So we would buy, 10,000 small boxes that they would charge us a quarter, and we would retail those to our client for $1.15, so, but we would buy a truckload. Well, those truckloads cost $25,000, $30,000 at a time. Well, think about that. When we had money in the policy, as you know, JT, is we could borrow that $30,000 against our capital. We had, a couple $100,000 in there, but we would borrow that $30,000, go buy those boxes. And then as the profits came in, the revenue came in from those sales, we would just replenish our bucket and put the money back into our bank and keep the excess profit, And so it allowed our money to compound every day inside of the policies, solve for the insurance component, but then give us access without having to ask permission from a bank. in a lending institution, and they charge typically a higher rate of interest than the insurance companies do for these policies. They do not maybe they were charging 7-8% when every time we accessed our line of credit. So it was just a cost savings. It was a control factor, overall tax savings later on down the road, and it was just hugely beneficial to us personally. So then down the road, as you know, we sold our company. I was able to part ways with my partner. We had an agreement. I took the policy that was on my life. He took the policy on his life. We both had our separate policies. Now I owned and controlled that bucket of money that was mine now. And my wife was the beneficiary versus my business partner, right? And my kids. And now it's our personal policy. So for the next few years, I continued funding it, continued growing it. I actually added a couple more accounts, one for my wife and another one for me. And we loved it. We used it as our cash account for our family, and we bought cars. We went on vacations. We renovated our home. All the things in life that just come along during those. My kids were probably in their 5 to 15 year age span of life, and we just did it that way. But then this is what the really cool thing was for me that as I started, as you know, I transitioned from that business into this business, and now I teach this professionally and go around the country and try to educate people on this. And as you will reference, is this strategy is taught, but really it is caught. Once you start using it and implementing it, it becomes such a, pardon the expression, no-brainer for people to understand and utilize. They start screaming it to their friends and their family, like, you got to do this and you got to try it. But you don't get there until you really start feeling it and seeing it for yourself. Even my wife had no idea what we were doing. I remember about 5 years into the plan, she was so used to our savings account growing, and then we'd spend it, and then we'd grow it, and then we'd spend it, and we'd fill it back up. She was so used to that for our whole life. This policy, after about 5 years of using it, and we renovated the deck, and we put a new air conditioning unit in, and we did some kitchen renovation, and then we went on vacation. And at the end of that, she was like, "Oh my gosh, our money has been growing the entire time." She couldn't understand it. And then it finally hit her. And I was like, "Yeah, I've been trying to teach you this the whole time. So trust me, I didn't teach her. It finally just, the light bulb went off for her. She caught it and she understands it. And then she was like, "Well, why don't we do more of this?" And we ended up opening up and playing on both the girls at that time and got them started down this road. But after that phase of life and seeing how it works for us personally, then my mind started working and saying, "Hey, I had, because it is a forced savings strategy, I kept putting money in, on a monthly or annual basis just to kind of keep filling up the coffers. It just grows. And at one point you look down, you got multiple 6 figures in these accounts, and you got a bucket of money that you can use, and so I started looking for opportunities at that time. And what's funny is I should be more honest. I wasn't even really looking for an opportunity, but an opportunity found me. And the first one that came along was, some real estate. A friend of ours was selling a condo down at Auburn University, and they had an incredible deal. They weren't really looking to make money. They were just trying to get out from underneath the condo they had. And it was just too good to pass up for me. And I had the capital to do it because I had the money that I've been reserving, and took advantage of that. And now I've got a condo in Auburn that, my tenant is paying the mortgage on, and a little bit of profits that go with that. And it's filling up my policy that I borrowed against to pay cash for that, So, but my cash that I borrowed from has still continued to compound and grow. And it's going to take me about 6.5, 7 years to pay myself back, pay the bank back. And then once I do, now I've got, $2,400 a month of just cash flow that's flowing into me, debt free. And it's a control thing. I could have gone to a bank and asked for permission and open up my life to, get them to say, yes, we'll give you a loan. But I didn't have to do that. And now I have control of the cash flow. I'm the bank. So I'm paying myself back. The debt, the principal and interest all goes back to me. And so if I lose a tenant, for 6 months, yeah, that stinks. But I just turn off that money. The insurance company doesn't come knocking for that loan because it's my loan. I own that loan. And so I'll just turn it back on when I replace a tenant, so I don't have to get antsy. I don't have to put a bunch of advertisement out there. I don't have to lower my rent just to get a tenant in. So it just gives me a lot more freedom and flexibility. Then the really cool stuff, and you know this one, JT, that I've been doing in the last 3 or 4 years is real estate syndications. Now I'm putting that money to work. That the Auburn condo is passive, but not really passive. I do have to stay involved and manage that property, and I've got tenants, and toilet goes bad, I got to fix it and replace it and all that stuff. Well, I really wanted to get truly passive. And in my opinion, real estate syndication is one of those things for the tax benefits, the truly passive income that you can get from it. Still an investment and a risk, right? But it's real estate. It's a pretty good, safe, sound asset that you can purchase and you can partake in without, they buy these $12 million portfolios of apartment complexes. I might be putting in a couple $100,000, but I get a small sliver of that and I participate in those benefits. And man, the returns far exceed what I'm doing in the market and other places right now. I'm knock on wood. Those are doing really well, getting 30, 40% IRRs on those things. But all the while, the money that I borrowed from my banking policies to put into those real estate investments, the money is working simultaneously in 2 places. That's the mind shift for people to understand. This is savings, the infinite banking strategy. The investments flow from it. We talk about it and we give a good example a lot of times, JT, of like a Walmart, a distribution center. Walmarts have retail stores. That's where they make profit. But to make those profit centers, those investments, their retail outlets profitable, they have to have distribution centers where goods can flow into to keep the shelves full. That's the way I have to think about it. My clients, I want them to think about this. That's what the infinite banking strategy is that distribution center for their capital. Their capital has to reside somewhere. It's basically either at the commercial bank or in a properly structured dividend-paying whole life insurance through a mutual company. We call it infinite banking. But that distribution center is that hub where your money resides. It earns tax-free. It's liquid. It grows at a compounding guaranteed rate. It's creditor protected. It provides life insurance and legacy planning. There's so many benefits that come with it. But then when I access the money, it doesn't interrupt the compounding and the growth on my money. So it's very foreign to a lot of people. So it takes time for them to understand it. But man, that's where I say, educate yourself, dig in deep. There's a lot of good and bad information about this strategy out there. We've been doing it for 15 years, personally and professionally, and teaching this to people. So I encourage your listeners, take a look at it, understand it, reach out. JT has been very, very knowledgeable and been a great student to learn this for the last 4 or 5 years and really uses it himself. I mean, we both practice what we preach. And he's been doing a great job getting the word out there. If anybody's interested and wants to learn more, it's a 30-minute introductory, educational call to learn a little bit about you, your situation, see if this is a good fit. This isn't for everybody. If you are a W-2 paycheck to paycheck person, probably not the strategy for you. I'm just being honest, But if you are building a little surplus, you have some excess savings, this is probably a good strategy. If you're a business owner, you have capital expenditures, monthly notes that you pay, you have equipment financing that you do, that's a great strategy for them. And then, the entrepreneurs, the real estate, those folks that are putting money in other assets to have those assets grow, a no-brainer. So we work with a lot of those folks, and there's some really cool strategies that we can do tax-wise and implementation and the setup of these things. But really it comes down to, you got to understand the structure in the beginning, how it works, how it functions, and then we can get creative how we design it. So
I mean, I appreciate you taking it away, make my job easy on this podcast today. For the listener and for myself, I think the biggest takeaway from what Mike just touched on was, he never really thought he was going to be doing these real estate deals and syndications. Kind of the name of the game is when you have liquidity and you have money that you can touch, it's pretty easy to find opportunities at that point. So this thing started out as just your operating account and your buy-sell agreement. Yeah. And then over the years, you started using it personally for your family, vacations, whatever the case. And now it funds all the, real estate acquisitions.
Yeah, it is. It's been a great, and you touched on another thing. This is not get rich quick scheme at whatsoever. This is get rich slow. It takes, some discipline. It takes some structure. It takes time. It does not happen overnight. Yes, we can eliminate some debts immediately. Yes, we can fund some things that, if you're getting engaged and you need a ring or you're buying a car or you need a down payment for something. Yes, you can fund those things. But what the really cool stuff tends to happen later as you've matured the policy, what we call there's an accumulation phase of a policy, typically the first 4 to 5 years. We can access the money and use it during those first 4 to 5 years, but that's kind of the growth phase. We're building the account. And then, man, it just takes off. For that next 5 to 15 years, boy, that's when the account really is starting to hum. The money is compounding at a great rate. You can start using it. And like you said, you don't have to find those opportunities. A lot of times those opportunities will find you, and then you take advantage. Look forward to helping your clients, man. Hopefully this was time well spent.
100%. Only other question I have for you, I know we touched on it briefly. I have, we brought it up. I have 2 policies on myself. You're up to 7 policies.
Yeah.
Just for the listener, for them to understand, why do you have that many policies?
Yes, great question. So these policies do have some IRS guidelines. So they have a maximum and a minimum that we have to abide by. And that maximum number you can only do for about 5 years. We can overfund for about 5 years, get the policy really mature and structured, really efficient. But then the IRS says, okay, that's enough. We can't keep stuffing this thing. Otherwise, it becomes an investment, which becomes taxable. So we have to stop. The reason I have multiple policies is, number one, I liked what it was doing. I wanted to do more, but I couldn't overfund my existing policy. I had to start a secondary one to put excess money into. And then the second thing is what we call the paid up additions riders. When those riders dropped off, I went from 20,000 funding a year down to 8,000, and I wanted to put that 12 somewhere new. So I just started a secondary policy, and it's just the nature of life. I just turned 50 last year, and just like many of your listeners, I made a lot more money at age 50 than I was at age 30. And so luckily, my lifestyle hasn't grown as much, Yeah, I've done some things differently than I used to do. And I've got some pleasures that I used to not participate in back in the day, as far as country club membership and things like that. But I've still lived within my means, and being able to do that has allowed me to save more into these buckets. So yeah, we've got 3 on me, 2 on my wife, and 1 on each of my girls. Now I own the ones on my kids, but one day when they get to your age and in their mid-20s, and I feel like they've got their life settled, they're paying their own bills, and that's going to be a great bucket that we can transfer to them tax-free. I wish my parents did it for me, 20 years ago, like we did for them. So it's going to be a great wealth transfer tool that we can use. So multiple policies. I'm actually on structure right now to get another one by the end of this year. So hopefully I'll be adding policy number 8 this year. So not because I need more insurance, I need another place to park capital. Which is a great problem to have, right? The gentleman that created this, Nelson Nash, he had 47 different policies. They weren't all on him. His family, kids, grandkids, nieces and nephews, did it on business associates. As long as there's an insurable interest, you can own a policy on somebody. Anytime there's a need for insurance, you can create a cash valued policy, not just a traditional whole life or term policy. You can do this type of structure. And that's something we didn't touch a lot on, JT, is the structure of these policies means everything. This is not your grandfather's 90-year-old life insurance policy. You got to work with a coach. You got to work with a professional that knows how to properly design these plans and use the right product for this. There's some products out there that are built and look really sexy on paper, but they have a lot of gotchas. We tend to use for this plan, not that those are bad products. It's just, they're not built, in my opinion, for infinite banking. Infinite banking is traditional whole life insurance structured in a way for cash accumulation, not for death benefit. We minimize the expense, grow the asset. That's the goal for us and for our clients. So there's a lot of education that goes into that, and we'll teach each and every one of you guys how that works.
Fantastic. One thing that pops out to me we can wrap up with, you touched on how this concept is caught, not taught, right? We try our best to teach it, but until clients get in there and start actually taking policy loans and using the money, that's usually when the light bulb goes off.
Yeah.
You're 50 now, and you started this, 15, 16 years ago?
Yeah, 34 years old, yeah.
So if you could go back to your 34-year-old self before you got all this rolling, what would you tell him?
Yeah. Well, first, I wish I would have started when I was 24, not 34, but that'd be the first thing. Because just like the nature of compounding, I could have started smaller and had just the same amount of benefit in the long run. You know, the power of compounding is the number of years obviously helps in that nature, but just using it, I think we started that policy for the business and I really didn't feel it internally because we were just using it for business purposes and it was working great. But once I got it transferred to me personally and I saw that my personal savings account wasn't fluctuating every single month, that's when the light bulb went off for me. And by that time, I was like, oh my God, I got to get one on me, my wife. We really took off at that point. So really, I didn't get hot and heavy into it until I was almost 40. But the light bulb went off. And to your point is I noticed that cash has a cost. And anytime cash went out the door, there was a cost for that. I'll never earn on that $2,000, $5,000, $7,000 expenditure ever again once I spend that money. It's great. I like cash and I like the control of cash because I get to control how much I put in and I'm not on the hook for anything when I use it. But that money's never going to grow. And you think about a 40-year lifespan of capital in your life, your working years, there's a lot of $5, $10, $15,000 expenditures. If you could pile that all together and earn at a 4.5%, 5% guaranteed rate of interest on that pool, that volume of money, it's not about rate of interest. It's about volume of interest. And if we can focus on volume of interest and how do we grab all those crumbs and make a loaf of bread out of those crumbs, man, you got a pretty big loaf by the end of it. So that's, I think, the one mindset, if I could teach, is we are so hyper fixated on rate of interest, whether it's a loan that we take or our accounts that we invest in. It's always, what's that rate of interest we're getting? It's not this structure is about the volume of interest. What can we earn on the big dollars of our lives? So that's a great, great point out. Thanks for bringing that up.
Yeah, I know for me personally, that was what made the light bulb go off was, hey, would you rather earn 5% on 1 million or 10% on 100,000?
That's right.
So
Yeah.
we're just trained to say, oh, I want a high rate of return. But that's for an investment. And like you talked about today, an investment's dollars have to flow from somewhere.
Yeah.
And this is just going to be that holding tank.
That's right.
I know a lot of the times people are like, oh, well, I want to get into infinite banking, but I want to do this real estate deal first, or I want to buy this car first. And it's like, hey, we're not trying to change what you're doing.
Yeah.
We want to change where the money's coming from.
And not to give a free plug here, but I'm going to take advantage because you just teed it up. Is we have a podcast that teaches this called Save Yourself Podcast. And JT, you can probably share the link to that with people. But one of the podcast titles is the and asset. To your point, what you just mentioned is this is not an or decision. Hey, I'm going to do infinite banking or real estate. It's an and. We get to put the money into the policy and do the real estate simultaneously. We don't want to slow our clients down from growing their wealth. Absolutely not. We want to enhance what they're doing, be more efficient with it, be under control, be more tax efficient. That's the and is the beauty of it. There's just not many financial vehicles that do this. And that's what you just got to get past that. You have to think a little differently, open your mind. It's all about the way you think, and once you understand this, it becomes pretty simple.
Awesome. I think that's all I got for us today, but you touched on it. So Mike's podcast is called the Save Yourself Podcast. You can also find a lot more resources at unlimitwealth.com.
Yep. Unlimitwealth.com. We got articles, videos in there. It's great resource guide. It's just purely educational. It's not a click funnel. You can get all the information for free and educate yourself, learn about it, reach out to JT, schedule a meeting, and we'll jump on there and talk to you guys.
Fantastic. Well, I appreciate your time today, Mike. I teed up infinite banking a bit in the intro episode, but obviously having you dive into the weeds is going to be beneficial for the listeners.
Thank you.
Appreciate your time today and hope everybody enjoyed. Mike Schwallie, joined here by JT Miller on the Vault Talks podcast. Look forward to seeing you guys next time. Thank you.
Take care.